Hello and welcome to another accounting tutorial. In this video, we'll be covering the topic of capital transactions and more specifically, the non-current asset register. But firstly, you could hit the like button, subscribe to the channel and click the bell icon. It'd be hugely appreciated. I'll be bringing regular content to the channel, try and help you further your accounting knowledge and hopefully help with your exam preparation. The aim of this session is to discuss and extend your understanding of accounting for capital transactions, from accounting for the purchase through to its disposal in the non-current asset register. But firstly, what are capital transactions? Well, a capital transaction refers to the entire process of buying, looking after and disposing of a non-current asset. It's also noting that everything I cover within this video will assume that the non-current asset will last over 12 months and bring some kind of financial benefit to the business. So that doesn't have to mean actually generating cash. It could also refer to an asset saving the business money, which would still classify as a financial benefit. When we buy a non-current asset, it's usually quite an expensive item and wouldn't tend to form part of your day-to-day purchases as a business. What this means is that you would more than likely have to follow a different process to purchase. The most common difference here would probably be the approval process, which may need to go to the highest levels of management or owners to authorise. Now, capital purchases does cover a huge range because we could be talking about a business of 10 people buying a laptop for a new starter, or we could be talking about an entire laptop refresh for HSBC. There's obviously a vast difference between the two, but both will be classed as capital expenditure. Now, this brings us nicely onto the authorisation levels or process, because depending on the size of the spend, it'll probably determine what level of authorisation it needs. So for example, a manager responsible for one section of the business might be able to approve low-cost items such as the purchase of a chair or desk. But if it's a larger business, you may have a capital expenditure committee, which will approve the higher cost items such as installing a new finance system or purchasing of fleet vehicles. Now, the owners or directors will approve the largest applications, which usually have a high impact on the direction or performance of the business. So the next thing to consider is what must be taken into account before you actually buy a non-current asset. So firstly, the cost. This is fit with the business's plans and budget. Secondly, how do we fund it? Is there enough money in the bank that we can buy it outright? Could we sell or part exchange an old asset to provide some of the money? Could we get a loan? But just keep in mind that there usually would be interest on a loan because borrowing isn't free. We also have hire purchase or finance lease as an option, and we'll come on to these specifically towards the end of the video. There's other things to think about too. Will there be any training required? We'll need this for new staff, or could it mean redundancies, for example? So just other things that we may need to consider. At this point, we can introduce the non-current asset register. This is a way that business can keep track of their assets by keeping them within their own log with all the required information related to those non-current assets. This sort of information recorded within the non-current asset register could include such things as the asset description or serial number, the date that it was purchased, how much it cost, the method and rate of depreciation, the depreciation charge for the year, carrying amount, how much the asset is effectively worth within our accounts, and the funding method, so how was it bought. Now, if we've disposed of it, that would usually include the disposal date and proceeds as well. Now let's look at an example. So here we have the basic format of an asset register. In this example, we can see that the category of asset is here, followed by the details of the asset purchased on the 8th of September 2017, this being for a laptop. We can also see the original cost, the depreciation value, and the net book value at the end of each year. Finally, we have the disposal date and the amount the business received for the asset. It's worth noting at this point that it's good practice to do a physical check of the items listed in the register from time to time to make sure you still have them. Now let's get into a case study to see how this would work in practice. Hawkins Limited purchased a new van with the registration number UPS1D3D on the 10th of September 2018 for £18,000 using hire purchase. The year end we're working on is the 31st of October 2021. The vehicle depreciates on a reducing balance method at 30% per year. Depreciation is charged in full in the year of acquisition, but nil in the year of disposal. The vehicle was sold for £5,500 on the 14th of October 2021. Complete the non-current asset register. So let's bring up a blank asset register. Our starting point, as you can see here, is to draw up a blank asset register, and the purchase in this case study was a van. Therefore, the category chosen will be vehicles. The next step will be entering the details for the acquisition, which will look something like this. We can see that we've identified the van and the registration number, and it's important to have more defining descriptions than just van, because in the future, if we were to purchase another vehicle, it could possibly get a bit confusing, not knowing which asset is which. We've also got in there the original cost and the funding method, which in this case was through hire purchase. Now, the next stage in recording the asset, and just to say this would form part of the monitoring or control part of ownership, would be recording the depreciation and the net book value of the asset. The net book value, if you aren't aware or haven't seen my video on depreciation, is just how much the asset is worth in our accounts. So back to the case study. So we've recorded the initial acquisition of the asset. Next, we can see running down the left-hand side, we now have the years of ownership. Now it states in the question that this asset is to be depreciated on a 30% reducing balance method. Again, for more information on depreciation and how it's calculated, etc., there's a full video I've done specifically on that topic that I'll put a link in the description to. So you can see from this, we've calculated the depreciation for each year and shown the net book value of the asset at the end of the year. The final stage is to show the disposal of the asset. We're now in the final year of ownership, and let's just remind ourselves within the case study it states depreciation is charged in full in the year of acquisition, but nothing in the year of disposal. So no depreciation in the year of sale. It says the vehicle was sold for £5,500 on the 14th of October 2021. To record this, we can see that we've entered the sale value of £5,500 in the disposal proceeds column and the disposal date in the disposal date column. Fairly logical. One point to note here though is, and this is key, we need to enter 0 in the depreciation column in the year we sold the asset, because that's what it specifies in the case study. And we also need to enter nothing within the net book value column because we no longer own the asset. Now I'd like to go on to looking at different ways of financing an asset in more detail. So firstly, we have a cash purchase. The business has sufficient cash in the bank, then brilliant, that is obviously the least complicated method that we could use. We'd also part exchange, where we actually trade in the old asset as part of the purchase price of the new asset, with the remaining balance either being paid with cash or through borrowing. We then have a ye olde faithful loan. This is usually an agreement between the business and bank or finance company where they lend you an agreed sum of money to fund the purchase. Ownership of the asset would belong to the business from the start. We then want to look at hire purchase and finance leases. Now, a hire purchase enables a business to have the use of a non-current asset, usually on payment of a deposit. You would then make regular payments to pay back the cost plus interest. At the end of the hire purchase period, ownership of the asset usually passes from the finance company to the business. So the business owns the asset once it's paid off. Finally, we have finance leases. Now, with a leasing agreement, the business has use of the asset, but it's owned by the finance company. So you would make regular rental payments to the owner of the asset. At the end of the lease term, the business would simply hand back the asset to the owner. So you're effectively just renting the asset out over a period of time. So that wraps up this video. I really hope you found the information here useful. And again, you could hit that like button and subscribe to this channel. I'd be really grateful. Thank you for watching. I'll see you in the next video.